We are diving into an analysis report on JPMorgan's $8 plus overweight rating for open door technologies.
Right.
In short, the report argues that the market is just completely mispricing the company's pivot from a capital-heavy house flipper to a software-first operation under what they're calling Open Door 2.0.
And, that narrative is the key. The whole idea of framing this shift under the new CEO as a refounding that's focused on a Rule of 40 software mindset.
It's very compelling.
It's a highly effective way to reposition the whole investment thesis. But, and this is the first big point, if the entire valuation hinges on that story, we have to strengthen the technical foundation for that shift to hold up.
I agree. The analysis makes a strong case for management's vision, but right now it feels like it's relying, almost heavily on assumption rather than observable evidence.
Exactly.
The argument is that they're launching over a dozen AI-powered tools and automating, but the whole bullish case feels weighted toward the CEO's Shopify background and the promise of a lower-cost structure.
And that's where the core analytical weakness is. For a successful tech multiple valuation, which is what gets you from, say, $5 to $8, the analysis has to show proof that the transformation is actively succeeding.
Not just that it will succeed.
Right, not just that it will. Relying on management pedigree and these, general concepts of efficiency. It just risks reducing the whole tech pivot to wishful thinking. The market needs to see the steel behind the structure.
That makes perfect sense. So if the $8 target is all about Open Door becoming a software company, the report needs verifiable checkpoints showing the tech is working right now.
Absolutely. Which is why strengthening the technical foundation underpinning the valuation shift is so essential for a robust analysis. The material has to move from just believing in management's intent to actually assessing the success of the technology implementation.
So how do we suggest they bolster that argument? Because, detailed tech metrics, internal API performance, things like that, they're usually proprietary. You can't just find them in public filings.
You can't. So the suggestion is to bolster the argument by finding effective proxies. Integrate the claimed technical efficiencies with current or recent operational data, even if it's preliminary.
Okay.
This transforms the analysis from a narrative based on a CEO's resume to a quantifiable assessment of how well it's all being implemented.
So you're saying find metrics that should improve if the AI is working, and then show that improvement happening.
Precisely.
What are some concrete examples of those technical proxies they could use?
You have to look for the downstream consequences of the AI. For instance, the analysis could find metrics on the reduction in human-driven pricing errors, or maybe specific improvement percentages in risk assessment timeframes compared to the old Open Door model.
I see. So if the AI is handling pricing and risk better, those errors should be shrinking.
They should be shrinking, and transaction velocity should be picking up. Even small, verifiable indicators of increased speed or fewer errors lend significant, measurable weight to that whole software-first claim.
That's really specific and actionable. It turns the tech shift into something you can actually measure. But let me push back a little. What if they just can't find those internal Open Door metrics? Is there a broader, more structural proof they could offer?
Yes, absolutely. And building on that point, they could identify a peer comparison, a logistics-heavy company that successfully transitioned to being valued as a real tech stock.
Like who?
Well, think of a company like Tesla, right? It went from being valued as a traditional automaker to a software company because of its battery and AI stack. The report could map Open Door's transition against that kind of trajectory, showing exactly where Open Door stands right now on that spectrum of technological proof.
So the core insight here is that if the technology is the real differentiator, the analysis has to spend less time talking about the jockey, the CEO's background, and way more time proving the success of the horse, the operational results of the tech.
Exactly. Without that evidence, the entire $8 valuation just remains vulnerable.
Okay, that's a very strong first point.
Right. So we've established the need for that operational proof. Now, let's pivot to the timeline for profitability. Because those efficiencies, they only matter if the housing market actually cooperates.
That's a perfect segue into our second major point. The whole bullish thesis here really relies heavily on management's commitment to reaching adjusted net income break-even by the end of 2026.
The magic date.
Yes, and that it's all driven by this idea of ruthless efficiency. It's the central financial pillar of the analysis.
And the report does make a strong, detailed case for how management is committed to that, cutting consultants, vendor bloat, all of that. But it needs to more aggressively stress test that 2026 timeline against the reality of the housing market.
You can't just assume favorable conditions.
You can't. And that's the potential Achilles heel here. The weakness is that while the analysis correctly identifies, interest rates and slow housing volume as the main risk, it doesn't connect that risk directly back to the timeline in a meaningful way.
It sort of presents the efficiency cuts as this linear, almost guaranteed path to profitability.
And that risks overlooking the severe impact that a prolonged low volume or high rate environment has on the necessary scale to achieve break even. It doesn't matter how deep your cost cuts go.
Right.
Cost efficiency makes them lean, sure, but only volume generates enough revenue to offset the fixed costs that are just inherent in a logistics business.
So what you're saying is the real high-risk element isn't whether they can cut costs. It's the timing of the macro recovery.
Exactly.
If volume stays depressed, even the most efficient software model in the world struggles to get the sheer number of transactions they need to break even.
That's it. So the suggestion here is to create a clear, modeled link between housing volume expectations and the financial timeline. The report has to model how much longer break-even gets delayed if volume recovers at, say, half the speed that the report currently assumes.
That shows robustness, rigor,
and intellectual honesty about the high-risk nature of the call.
I can see how that adds a ton of value, especially for an investor who's trying to calibrate their risk. How should they structure that analysis, though?
They need to introduce a true sensitivity analysis. Go beyond just saying volume is a risk. Quantify it.
Give me an example.
Okay, for example, define scenario A as the base case. Housing volume recovers moderately, and they hit the 2026 target. Fine. Then you define scenario B, the high-rate persistent scenario, where volume stays flat or even slightly negative year over year.
And then you model it out.
Then you model how that persistence forces break-even to shift out to late 2027, or, even early 2028. Quantifying that delay makes the risk crystal clear and gives a forward-looking metric.
That's excellent. It provides the connective tissue between the macro risk and the central financial goal.
So there's a second really useful point here. You can use the efficiency cuts themselves as proof of the new volume requirement. So you analyze how the lower cost structure changes the necessary volume of transactions Opendoor needs every month or every quarter to hit break even.
So instead of just looking at the P&L from the top down, the analysis should figure out the minimum viable number of houses they have to flip.
Precisely. Think of it this way. How many houses do they need to sell? It's the difference between needing to move, say, 1,000 houses with the old expensive cost structure versus maybe only needing to move 600 houses with the new software-leveraged one.
And that number, that volume requirement, becomes a tangible, trackable metric.
Exactly. It provides a volume-based validation of the new tech structure and profitability targets. It makes the thesis much harder to dismiss because the market can actually track their transaction scale in real time.
By quantifying that, the analysis creates a real-time yardstick for management's progress toward 2026, regardless of the housing cycle. It moves the discussion from can they cut costs to at what market speed do those cuts actually become profitable, which is a much more sophisticated analysis.
It just fundamentally strengthens the analytical depth. Okay, so we've covered the operational proof and the financial timeline risk. Now let's get to the key question. How do we structurally justify that $8 price target? That's the reason the report exists.
Right, which deals directly with the valuation, our third and final major point. The report states clearly that JPMorgan believes the market is valuing Opendoor as a house flipper.
And missing the software shift.
Which is what justifies that significant upside.
That's a powerful assertion. But for the analysis to really maximize its precision, clarifying the fundamental shift in valuation methodology from flipper to tech, that is absolutely crucial.
So the report tells us what the market is missing, but it doesn't explicitly define how the new valuation is actually constructed.
Exactly.
The weakness is that the $8 target is just presented as an outcome, a result of the new strategy, but the material doesn't show the mechanism of the multiple change. It feels like a speculative leap without the math to back it up.
Right. If the whole thesis relies on shifting from valuing the company on real estate metrics like price to book or price to tangible assets,
which focus on physical assets,
which focus on hard assets, to a growth-oriented multiple common in high-growth tech like price to sales or a forward EBITDA multiple, the analysis has to quantify that change. Leaving that gap makes the $8 target feel, well, less structurally justified.
That makes perfect sense. This reminds me of the early days of Netflix. It was valued on DVD rentals until they proved the streaming model could earn a tech multiple. We need to see how Opendoor achieves that same kind of fundamental re-rating.
That's the analogy the report needs to make concrete. So the suggestion, therefore, is to explicitly detail the change in valuation metric that enables the $8 target. Connect the technical pivot directly to a new financial multiple.
You have to ground the tech multiple valuation in quantified terms.
You have to.
But how do they actually go about quantifying that shift? It's a huge jump from valuing houses to valuing software.
We just need to see the math that supports the narrative. First, the analysis report should clearly state the range of multiples typically applied to logistics-heavy house flippers. That's the old valuation.
Okay.
And then compare it directly to the target multiples applied to verticalized, software-first logistics platforms, the necessary new valuation. You have to show the delta. The report needs to basically say, we are moving from a price-to-book multiple of X to a price-to-sales multiple of Y.
That defines the theoretical shift, but we need to connect that back to Opendoor's operational changes, right?
Absolutely. To make it even more compelling and defensible, they should explain which specific financial metric, say the gross margin on services revenue or transaction-based revenue, is expected to grow fast enough and consistently enough under Opendoor 2.0 to actually justify that higher price-to-sales multiple.
That's the key. By clarifying that connection, the analysis tells the reader exactly what to watch for in future earnings reports to confirm if the valuation transition is happening. Is that higher margin actually materializing from the new automated systems?
It transforms the analysis from a subjective opinion on the company's future into an objective framework for judging their execution. It's a highly effective way to structurally validate the analyst's confidence in that higher price target.
We've covered a lot of ground today on how to strengthen this bullish case for Opendoor. The foundational narrative of Opendoor 2.0 is compelling, but to really maximize the impact and credibility of the analysis, 3 high-level revisions really stand out.
The first is bolstering that narrative with concrete evidence of the AI tool execution and efficiency gains. Use operational proxies, like error rate reduction, to prove the technical shift is really underway. Move past just relying on management pedigree.
Second, applying rigorous stress tests and sensitivity modeling to that 2026 break-even target, specifically modeling the impact of different housing volume recovery scenarios to provide transparency on the risk and establish clear volume requirements for profitability.
And third, clearly defining and quantifying the necessary shift in the valuation multiple. You have to move from a real estate logistics metric to a software platform metric and show how that structurally justifies the $8 price target.